And here on our news, it says, Pundit, Michael Saylor just flipped XRP holders, you'd better watch this. Right? And that's from our news source, Times Tabloid. So, why are the two biggest market drags suddenly moving backwards? Have you ever noticed how the cryptocurrency market can feel like an interconnected web where a single event thousands of miles away can instantly impact the digital assets in your personal wallet? If you have been sitting on the sidelines watching your assets fluctuate over the past 2 weeks, a prominent analyst on X named Levi Rietveld just pointed out a massive double reversal that you absolutely cannot afford to ignore. We are witnessing two of the largest macroeconomic and geopolitical dark clouds over the market completely shift direction at the exact same time. For days, asset prices have been dragged down into a consecutive lower lows and lower highs, leaving retail participants feeling completely exhausted. But the tides are changing. The exact forces that broke the market's upward momentum a week and a half ago are now flipping back into a favorable position. If we want to understand why the price action is suddenly turning green today, we have to look directly at a sudden shift in behavior from Bitcoin's biggest institutional buyer, combined with a dramatic breakthrough in international diplomacy. Right? So let's start with our very first question about what happens now that Michael Saylor is signaling an institutional reversal. The first major catalyst that completely shocked the market occurred on May 26, when Michael Saylor broke his legendary streak and executed his first ever Bitcoin sale. Even though it was a relatively small liquidation to fund preferred stock corporate dividends, the psychological damage to the market was done. It created an immediate wave of panic, causing capital to pull back across the board and dragging down alternative assets like XRP in the process. When the ultimate accumulator sells, the market naturally flinches. However, the negative sentiment has officially hit a brick wall. Saylor just posted a major update on X, dropping a heavy hint that his company is right back in accumulation mode, stating explicitly that it is a good time to add more dots. His firm is firmly holding onto their aggressive roadmap to accumulate 1 million Bitcoin by the end of this year, which would command nearly 5% of the entire circulating supply. So, as a market observer, my takeaway from this is that institutional confidence is incredibly resilient, and retail panic is almost always a trap. When Saylor briefly sold, the entire market acted like the sky was falling. But looking at his actual corporate strategy, it is clear that his commitment to digital assets haven't changed at all. So to me, his latest signal is a massive green light. It shows that large-scale entities view the recent price drops as a primary buying opportunity rather than a reason to fear. When the leading institutional voice says it is time to buy, the rest of the market's capital flows naturally follow. Right? Now, the next question is, how are the US and Iran peace talks shifting the global risk environment? Alright? While institutional accumulation provides the financial foundation, geopolitical stability is what actually gives the market room to breathe. Back in June 2, geopolitical tensions reached a boiling point when Iran announced a rejection of peace proposals and launched drone strikes, sending a shock wave of risk aversion through the global financial landscape. When global stability is threatened, investors immediately flee high-growth digital assets and run toward safe havens. But just like the Saylor news, this geopolitical drag has completely reversed. Iranian Foreign Minister Abbas Arachi is actively participating in high-level diplomatic meetings with Pakistani envoys right now in Tehran to resume peace negotiations with the United States. Pakistan has been acts as the central mediator in these historic negotiations, trying to restore the ceasefire framework and reopen critical maritime trade routes like the Strait of Hormuz. So, in my opinion, this geopolitical back and forth has actually become a highly predictable and tradable pattern. Throughout this entire conflict, we have seen both sides constantly alternate between severe escalation and sudden diplomatic retreats. Every single time things look completely hopeless, diplomatic channels reopen and the market experiences a relief rally. This tells me that the recent downside wasn't based on a permanent failure of the asset class, but rather temporary external fear. Now that diplomacy is back on the table, that fear is evaporating, allowing capital to confidently return to the market. Now, why is compression near resistance setting the stage for a short-term move? When you take a major institutional buy signal and combine it with a massive de-escalation of global conflict, the charts are going to react immediately. On the shorter term time frames, the price action has completely stabilized and started printing green candles. The asset is now rapidly approaching a major long-term descending overhead resistance line. This creates a phenomenon where the price is getting compressed tighter and tighter against the heavy resistance wall. Usually, when price action compresses right under a major barrier at the exact same moment that the fundamental news turns incredibly bullish, it leads to an aggressive breakout. It is important to clarify that this isn't an indicator of a permanent multi-year trend change. Instead, this is a highly localized near-term technical setup pointing directly toward a short-term rally as we head into next week. So my assessment of this specific chart setup is that the bears are completely running out of ammunition. They used the Saylor sale and the drone strikes to push the price down as hard as they could, but they failed to break the major macro support floors. Now that those two negative catalysts have completely flipped to the positive side, the downward pressure is gone, but the coiling effect remains. When an asset is compressed against resistance with a sudden burst of positive fundamental energy behind it, the path of least resistance is almost always a rapid move upward. Alright, as an overall conclusion, the recent period of market stagnation and downward pressure was not caused by a failure of digital asset infrastructure, but rather by two massive external events that hit the market simultaneously. The psychological impact of an institutional giant trimming reserves combined with sudden geopolitical conflict created a temporary environment of absolute pessimism. Now, both of those specific variables have completely reversed course. Michael Saylor is actively signaling a return to aggressive corporate accumulation, and the resumption of mediated peace talks in Tehran is rapidly draining the geopolitical fear out of the market. On the charts, this double fundamental reversal is causing the price action to compress directly underneath key overhead resistance. While this does not guarantee a permanent macro trend shift, it gives sidelined participants a remarkably clear picture of what drove the recent drop and exactly what is fueling the immediate momentum back to the upside. Alright, and now this finally ends our video. Thank you very much for watching, and see you on the next one, or you might just as well check this recommended video right here on our screen.